if you're able to afford a third-party management company to run your day-to-day, it'll change your life. It'll quickly change the trajectory of your ability to build your portfolio, which is really kind of where you make your money, is being able to buy more deals and expand your portfolio, have more units paying you rent each month and making a profit off that.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 144. My guest today is Kenny Wolfe, and Kenny is just a wealth of information on multifamily and apartments, as well as triple net and double net commercial properties. Kenny is the president of Wolfe Investments, and he currently owns over 2,300 multifamily units, and he's about to close on another 188 units. He has also acquired a stake in a property management company recently, managing over 3,500 units. Kenny is a published author. He wrote the book Investing in the Dream, and he also does hard money loans. And in a previous life, he was the CFO of a large oil and gas company. Kenny, I'm thrilled to have you on the show. We met over the summer, and you are just an incredibly impressive and experienced person, so I'm thrilled to have you here. Thanks for being on the show.
Thanks, Brian. I appreciate it. Thanks for having me.
There's so much that you've done. Why don't you just kind of take us back to how you got into all of this to begin with?
So I got started in real estate via oil and gas. I was graduated from Baylor University and got an entry-level accounting job at an oil and gas firm here in Dallas, Texas. And then from there, kind of grew up in that, and then was thrown into a CFO role and junior partner into an oil and gas company there in Shreveport, Louisiana. So we did that for 3 years, and then my wife and I decided it was time to get out of oil and gas, as that's a very highly cyclical industry. And so we jumped into multifamily.
And what pointed you in the direction of multifamily? Why did you think that was a good way to go?
So we went to one of these 2-day events. And the first day at this event that we went to was a real estate event. They talked about single-family investing, and we were so excited at the end of that first day. My wife and I were talking about buying 10 single-family homes right off the bat here in Dallas, Texas. And then the second day they talked about multifamily, and then we realized that single-family is too much work. And we were fortunate to have the funds to jump right into multifamily. So that's where we started.
If you don't mind, tell us what the event was, how you kind of learned the techniques that got you into this in the first place.
Sure. So the 2-day event we went is here. It's a group out of Dallas. Their name is Lifestyles Unlimited, and that's who we went through first to learn there. We reached out to some family friends and asked them how they were getting into real estate, and she pointed us in Lifestyle's direction. Take
us through your first deal. How did that go? How'd you find it, and how'd you take it down?
So our first property that we bought as the deal sponsor was 76 units in Wiley, Texas. There's early 90s construction. We bought it for roughly about $45,000 a door back in 2012, and it just has been such a great investment for us. Part of that's timing, obviously, but we were able to push rents. It's just in a very quick manner from where they were when we bought it.
And how did you find and build your team, starting with 76 units?
To me, that's where we're having a mentor or someone who's been in the business to walk you through it is very, very important, because you've got they were able to shortcut our ability to find the right vendors, find the right management company, the right mortgage broker. By going through that, we didn't have any hiccups on that property at all, because we used their contacts, and they've kind of already weeded through the good and the bad vendors.
Yeah, I found when I did my first deal, I spent a lot of time talking to banks and lenders and management companies, and for every choice I had to make, I talked to 3 to 5 different companies or groups to figure out who I was going to go with for insurance or you name it.
Right.
But once I had all that figured out, it made it so much easier the next time because I just could call up my go-to person.
Right, exactly. Yeah, and you probably just need that mentor to walk you through the first or maybe second deal. But after that, we were kind of on our own and able to, we by that time we already kind of knew all the contacts we needed to get started, and I've obviously made more over the past few years too.
So if you go back to that period around 2012 when you were transitioning from your what I assume was a full-time job as a CFO in oil and gas to making that first 76 unit purchase, what were you thinking at the time?
Yeah, exactly. So we actually started in 2010 with 2 passive investments in multifamily, one being a value play, one a yield play, to kind of learn the ropes. So that's where we started out at. And from there, then in 2012, syndicated our first deal. By doing those passive investments, I was able to step down from that CFO role and take a 3/4 hour or a 3/4 time accounting position at a different firm to free me up to be able to go after our first property to buy as a syndicator.
I'm sure that made it a lot easier. You still had your foot in in a paycheck. You were still working a paycheck, but you were able to build in some flex time to that in order to pursue the syndication and the larger apartments.
Yeah, exactly. And I really suggest that. I know I hear people just quitting their job and going after it, but to me, we were going to wife and kids and everything, and so we were wanting to ease into that role a little bit better there because of the you've got those like the health insurance, and you've got these other items you got to cover. So that for our path that was the way to go.
You started with 76 units, but you've built it up over the past 7-8 years to over 2,300 units. I mean, that's an enormous portfolio. How did you manage to go from the initial units to where you are now?
So it's just a matter of looking at a whole bunch of properties and also expanding our search into different markets. So we were focused on Dallas-Fort Worth for the first 3 or 4 years of our real estate career, and then from there, about 4 years ago, I thought prices were too high in Dallas, so I called it a little early, but decided to go look at Oklahoma City, and then on the way back, actually driving back from Oklahoma City, it's about a 2.5 hour drive from our office here in Plano. I decided that if I was willing to drive one way 2.5 hours in a day, then why not get on a plane? And that really kind of opened it up. So we actually bought our first out-of-state property in Colorado Springs, 192 units up there, and then bought a whole bunch in Oklahoma City, and then we've got 2 assets in Columbus, Ohio as well. So we were able to hop to other markets, and that really opened up the deal flow for us, and which I think led to our quick growth from 0 to 2,300 units.
So how do you go into these new markets that are, you have to get on a plane and start a portfolio there without making things exponentially more time consuming for yourself?
So you've got to buy big enough to afford third-party management companies. That's because we're not there in the same city where, you've got to be able to rely on them to handle the day-to-day operations. And that's what we wanted anyways. That's why we started out with 76 units, because, I didn't want to have to do any of the day-to-day operations. So I still don't know how to evict anybody. And owning 2,300 units, because if you're stuck in the day-to-day role, it's going to slow you down building your portfolio. So, and on top of that too, now that we, when we were using third-party management, it helped us get into different markets faster.
And what were some of the challenges you faced along the way? Any mistakes that you made or things that you had to deal with that took a little bit of time to figure out?
I mean, we had to weed through some bad management companies. We got referrals from them, and everything looked good, when we brought them on, and then they just couldn't perform, and so we've had to fire three management companies now in our history, and that kind of led to buying a large stake into Allied Property Management to basically bring that in-house.
When you had to fire these management companies, what were some of the signs that you needed to do that?
They were all just very different. So one of them was that we were constantly at high 80s occupancy, but we had a lot of leases. Well, they could lease like no other, but the problem was retaining the residents, and so we gave them a 60-day time clock, on that to hit above 90%. And if they didn't, then we were going to have to move on. And so once we did that and got it, and they didn't hit it, and so they were removed as the management company, and a new one brought in. But once we got on site there and dug in, I heard all the horror stories about what they were doing. So like they were trying to tackle the mouse problem with essential oils. They were spraying for bugs in the units with just Raid, nothing more. So there was a lot of issues that even on site visits that we weren't able to see, and part of that was on us. We've got better at being able to recognize that. We were doing these days we're doing a lot more unannounced visits. We're walking more units on those unannounced visits and talking to residents, and to get that more of that feel, so we can avoid what happened there in Colorado Springs. So
I love that they were using essential oils to get rid of mice.
Yeah, right. Not gonna work.
Sure, the apartment smelled great, but the mouse problem, I'm sure, did not go away because of that. I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So before you bought into this new management company, and I do want to talk about that, you had to replace these three management companies that weren't doing so well. What did you look for the next time when you went out to find a replacement? Yeah,
we were looking for someone who was local, who was there in the market already, so like that. So we found a local Colorado Springs management company. The one that we had fired was based out of Denver. They had other experience there in Colorado Springs as well, but we just felt, having someone whose main office is there in the city would also bolster that up for that property. That was a big one. And then also too, each property is different. So if you have a B class, not everybody can, not all, management companies are created equal. So, some are going to be better at the A, some at the B, some at the C. So you just have to, plug them in accordingly.
Yeah. What is your criteria when it comes to buying apartments? A, B, C, what do you look for?
So mostly we've bought B and C the past few years. We've got one, what I call an A minus, is built in 2000 there in Columbus. But other than that, they're all, 80s, 70s, and we've got two 1960s properties. So that's mostly what we buy though.
And do you typically look for a certain type of property, one with upside, turnkey? What do you prefer?
I think it depends on the market cycle. So what the past 2-3 years we've been looking at heavy value add properties, or properties where we can assume their loan because they'll give you a discount on the price. Basically, so today at this part of the cycle, we're looking at any way to reduce our basis in the property, whether that's the deep value add or assuming their loan. But back in 2012, we what we thought was a yield play turned out to be a very high value play. And if you bought anything back then, it turned into a great investment. But back then we were buying, supposedly, just yield plays.
If you don't mind, just describe for our listeners what you mean by value add.
So value add would be your typical, fixer upper. So you go in, one of the first passive investments I did was a property here in Arlington, Texas, where we bought it for $13,000 a door. But the pizza delivery guy wouldn't go deliver pizzas inside that property. It was so bad for fear of being mugged. So that's your typical value play. Yield play is obviously one that's mostly fixed up, and you're buying it for cash flow.
So, what are some of the value add strategies that you like to employ?
We're pretty big on getting the kitchen all fixed up. That's, and most of these most of these apartment units you walk in, and that's one of the first things you see. So, we'll go ahead and put a glass tile backsplash in a C class, just to make that first big wow impression. Most of them we're doing faux wood flooring in. One, we typically get a rent bump for as an upgraded unit, but two, it's a lot cheaper long term to own and carpet in the units. So that's a big deal we kind of do. We look at possibly changing out toilets to save water, if that makes sense. As well, shower heads, not as much. The big savings on water is going to be the toilets. What else? We usually add a dog park of some kind. Sometimes that promote our pet rent. We'll do that.
How do you do a dog park? Just put up a fence, or what do you do?
Yeah, so one of our properties in Columbus, Ohio, had a sand volleyball court. So not many people were using a sand volleyball court up in Columbus, Ohio, for the majority of the year. So what we did was we put up some wrought iron fence there, and then to fence it off. And then we actually bought some dog agility equipment and put it in there, and some benches. I think all in it cost us $12,000, but completely worth it because no one else around us in that submarket has a dog park. So we have a lot of dogs on our property, which is good. I mean, we charge big. There's big deposits. Part of that's refundable if you're a well-behaved dog, and then most of our units have the faux wood, which is waterproof. So it's not too big of a deal if they have an accident. So,
if you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you're expecting a change in your healthcare insurance coverage for any reason, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. And let's talk about your management company. You recently acquired a large stake in a management company. Why did you decide to do that?
A few reasons. I was frustrated with other third-party operators. Some of them are okay. Some of them are bad. It's a highly fragmented industry. So I saw some opportunity there. Also, bringing that in-house, I'm probably going to get better service. And then three, a bigger picture deal was, there are actually two bigger picture items. So one is that when we start, trying to attract private equity money, they all want to see you have in-house management. And then the fourth reason would be, whenever the next recession hits, Fannie and Freddie like to turn over properties to owner-operators first, and then so that they typically get first crack at these foreclosures.
Wow, those are some really interesting reasons there, especially the last two, the private equity reason and the Fannie Freddie reason. Let's talk about those for a moment. In syndicating and raising money, you're looking for some of like the family offices, other private equity type groups. Am I right in that? And they like to see that you own a property management company to take care of the properties?
Yeah, so basically we have two tranches of investors. So we have a lot of, just individuals and couples that invest with us, through, they come find us on our website or whatever. And then we have to build that relationship over a meeting or a call or something like that. So, and then kind of our second tranche would be, what I call private equity. So these are folks that are based out of usually New York and then I was talking to one out of Israel where they would fund 90% of the investment. We would have to fund 10% of the investment. But it's those folks, those private equity folks, want you to have an in-house management company.
You're also positioning yourself for the next downturn because if you have a large management company, you're saying that Fannie Mae and Freddie Mac will be more likely to have you take over the property in receivership?
Right, exactly. Yeah, they always want to see an owner-operator be the receiver most of the time.
Since we're talking about it, I mean, what's your outlook? I mean, you've got your finger on the pulse of what's going on out there. You're invested in 5 different states. Where do you think we are in the cycle?
I think we're closer to the top than the bottom, but that doesn't really help anybody. It all to me, it all depends on that 10-year Treasury. That's basically what our economy runs on at this point. So if rates stay kind of where they're at, I can see it going for another year or two. But there's so many macroeconomic items that could be a force on it. If the EU breaks up, that'll keep bond prices low for a very long time. Which could help us run for even add to our historic run here, or and then you just never know geopolitically what's going to happen. So you kind of have to prepare for it all. We are seeing some with the interest rates going up a little bit, some softening in what the sellers are wanting in some of the markets we're in, specifically Oklahoma. We're seeing it there first. I don't know when that spreads everywhere else or if it does, but. I'm taking that as a good sign.
Say that again. What are you seeing in Oklahoma?
We're seeing some softening on what the sellers are wanting for their properties, which is nice to see finally. So
the sellers are getting a little bit more aggressive about selling their properties when it comes to pricing.
Right. We're seeing a little bit more of that, and because they're and I think too there's Oklahoma's a little bit different. There's not as many people there buying properties, so we're usually when we go to buy a property, we're maybe one of 2 or 3 folks in the conversation, whereas here in Dallas you're probably one of 20 or 30. So it's a little bit different up there in that market, but we are seeing that there's the softening there on those prices, which I'm excited about.
And how are you doing it yourself? I mean, you're looking at properties, you're making offers. You've got 188. You're going to be closing on this week, actually. So obviously, you're still finding deals and finding value. Is it getting harder and harder for you, or is it getting easier in some ways?
Well, I mean, it's been hard for the past 2 years to find truly good properties. The ones we've bought have been off market properties where we've got to usually have a buyer broker. So in a few of our markets that we're in, I found 2 of them. I found 2 really good buyer brokers who are contacting owners on our behalf. So we're that's been a really great tool for us there. And then also being willing to assume some of these Fannie Mae loans has made us look a lot more attractive to some of these sellers.
Yeah, talk about that. So you're finding other owners who have Fannie Mae loans and you're able to assume them. How is that creating opportunity for you?
So the sellers are, they're staring at a huge prepayment penalty on these Fannie Mae or Freddie Mac loans, right? So they don't want to give up that huge dollar amount of that. So like on this El Paso deal that we're closing here on Friday, we're assuming it's Fannie Mae loan. Basically we split the difference on that prepayment penalty. So he's saving, $600,000-700,000 by us assuming that loan.
For our listeners who might not be familiar with the concept, assuming, what do you mean when you say you're assuming the loan, and what are the costs that are usually associated with that?
So assuming the loan is about the same cost as getting a new loan from Fannie Mae. So there's really not much of a more cost. These Fannie Mae and Freddie Mac loans are typically amortized over 30, but they're all balloon payments and usually 7, 10, or 12 years, depending on which one you choose from the get-go. So this one's got about 3 years left on it, on the loan. So our plan is to go in, do our business plan, and then do a cash out refinance probably by year 2 or 2.5, to basically pull almost all of our equity out of the deal and then hold it another 7 years or so, or 10 years.
So let's get back to your management company. I mean, you own in 5 different states. Is your management company, are they managing all of those properties for you now?
Yes, they are. Well, they've got all of our Texas and Oklahoma properties. We're still transferring over the Ohio properties probably by the end of the year.
And how do you set yourself up then to be able to have oversight over all of the properties that you own?
So, we've got a staff here at the office. I've got an asset manager. So he and I handle the oversight of the management company here from our office. And then we were just in Oklahoma City for the day yesterday, checking on 2 of our properties. One of them is going through a huge rehab. So it's a lot of weekly phone calls. It's by email, and then occasional trip on a plane. Usually, if the property's after we get past the rehab and it's stabilized, we'll visit the property every 2 or 3 months. If we're going through a rehab, it'll be more than that. And then also if it's not stable yet, we'll be going more than 2 or 3 times a month as well, just to check up on it, make sure we're going the right direction.
And what are some of the systems that you've put in place that you find save yourself a lot of time?
A new one is using Trello. It's Trello. And so you're able to, it's basically a huge to-do list, but it's shared in real time to whoever you want to. So, we've shared that with our regional manager on that property and the construction crew if there is any kind of construction rehab component to that property. That way, everybody's on the same page. We can all make notes on the property, and it's a way to keep the to-do list in front of everybody all the way through the transaction and management of it.
Wow! So that you use that at every step, from the transaction to the ownership and the management of the property.
Right. Yeah. So during the transaction, we would share that with different folks that are loading it into to the property management company. But yeah, it's something that we use here in the office that to me has really helped. We actually just rolled it out maybe 2-3 months ago. But I'm pretty excited about it because it'll be nice to have everybody on the same page and communicating a lot faster.
Tell us again the name of that and spell it again.
Trello, Trello.
If you just rolled that out 2 or 3 months ago, how has that improved your performance? I mean, are you able to measure just how much more efficient it's made you?
Not, I don't think in a concrete way, but yesterday we were up there in Oklahoma City, and you could tell that the regional and the on-site manager and the construction piece to Ally were on the same page a lot better than they were before we introduced it. And so it's going to make us move that much faster on this rehab and get it done quicker. And then also too that the on-site folks can direct, hey, we need these units done faster than this, or this certain unit type done faster than others, and kind of direct it that way as well.
What else has helped save you time?
Having the weekly phone calls with the regionals has been huge. We look at we look at the weekly reports as well, but actually getting them on the phone. We've done that for years, but that's been a huge help.
And if you weren't doing that, what are some of the miscommunications or things that you were finding might fall through the cracks?
If you're not having those weekly phone calls, it might take an extra week to get one of our, or to have the idea of having a new upgrade unit to try out, I don't know. There's so many moving parts to managing a property that you really need to be dialed in at least once a week, going over the to-do list, and then if anything else comes up, a way to capitalize on improving the property faster.
Yeah. I'm intrigued by this the weekly phone call. And I'm just wondering like how you run it and how you make it as efficient as possible. Like what are the actual tactics you use during that phone call?
So now that we have Trello up, it's really easy. It's really streamlined. There's no guessing as to what the to-do list is. On the phone call, we all just bring that up and we kind of run down through that to-do list and and kind of get up to speed on all those items. And it makes it a lot more efficient. Our phone calls probably for a property with the regional each week is maybe 30 minutes now, where it used to be maybe an hour. It's really cut that down in half because of that, using this new app.
And let's switch gears a little bit here, because I want to talk about your triple net and double net properties, because it's not just, it sounds like it's not just multifamily and residential that you're investing in, but you've also got some other type commercial investments as well.
Right, yeah. We put together a commercial real estate fund where we pool investors' money together to go out and buy. We ended up buying 7 of these double net or triple net dollar stores. So we bought 5 Family Dollars, a Dollar Tree, and a Dollar General, and within that fund.
Yeah, and how are those working out for you?
They're going great. Those are such a lower operational risk than multifamily. So and by that I mean that the rent just shows up on the first of the month. The mortgage is taken out on the third. We don't have to deal with fixing any toilets or light bulbs or anything at the property level. For the most part, our double net stuff that where we are responsible for items, it's items like the roof, the AC, and the parking lot. So those are kind of bigger ticket, long-term items.
And how would you compare the returns you get from the triple net and the double net to what you typically would get in multifamily and apartments?
I'd say these days it's slightly lower. So our cash on the triple net stuff is about 8%, and then we're getting a higher principal pay down return, annual pay down return of about 8.25%. So before appreciation, we're at 16.25% a year on these triple net deals. So our multifamily, we've been able to double everybody's money in about 3 years or less. But part of that's the market too. So that includes the appreciation.
Getting loans on the triple net or double net, how does that differ from apartments?
So those are recourse loans, so that's something to keep in mind. We did find a lender out of Missouri that's given us 80% leverage and 25-year AM loans on those on our triple net stuff. So that was a great find. Typically, you see 70 or 75% leverage, but they're willing to go to 80.
And how many years?
And it's amortized over 25.
Fully amortized, or is there a balloon payment somewhere in there?
There's a balloon, so they usually make that balloon equal to the initial term of the lease.
So the loan comes due when the lease gets renewed.
Exactly.
Gotcha. Okay.
Or right around that time period. Yep.
And you're doing more of those as well.
Yeah, we're about to kick off another fund here in probably about 2 months or so. All the investors seem to like it, so time to go buy some more.
Yeah, it's nice steady money. Doesn't have the fluctuations you might find in residential.
Right.
Oh, what about hard money loans? You want to talk about that at all?
And we also do hard money. That's one of our other offerings that we send out to our investors. Those deals we're the bank. We lend the money on these to single family and small multifamily investors. The biggest one we did was a 36 unit down near Baton Rouge. Hard money loan. That one's supposed to be paid off here in 2 days, so that'd be good to get that money back. But it's been hard to find those folks to lend to because the banks are getting involved in these hard money loans. So some of these bigger banks are lending at 7-8% terms to these flippers, and that's really and they're willing to go up to 90% of the after repair value. Which if we have a 10% correction in real estate valuations, then these banks are gonna take a bath on them.
How great of a warning sign do you see that in the overall market?
Here in Dallas, it's amazing to see what they're willing to lend on and such a high after repair value. It makes me uncomfortable. There's no way we would lend that much on a property. Just because in case there's a correction of more than 10%, you're kind of up a creek.
Yeah, I mean, it seems like they're repeating some of the excesses they were doing before the last Great Recession.
Oh yeah. I think we're back. I mean, that you can walk into Capital One these days, and if you've got a pulse, you can get a $50,000 loan. Now it's at a 12% rate, but I mean, that's still, I feel like they're not doing as much homework as they should.
Yeah, I'm sure not as much homework as you're doing. As a hard money lender, what do you consider to be safe parameters?
So typically what we'll do is we'll lend 70% of the current value of the as-is value, and then up to 100% of the rehab based on draws. So that way we're always probably at least 70 to maybe 75% of the value of the property. As it gets further along, we'll have a lower leverage loan as the value goes up.
And what kind of interest rate would you typically charge?
So we do 2 points at closing, and then 12% annual interest rate, but there's no prepay, so they can exit whenever they are able to.
Nice, yeah. So it's kind of hard to compete with Capital One or any of the other lenders that have got it.
Yeah, I mean, if they're doing 8 or 9%, and a much higher, and a much higher leverage on the loans, then yeah, I mean, there's just no way we can compete at this time. I mean, it'll come back. It always does.
Oh, yeah. So I want to ask you about your book. You recently wrote a book called Investing in the Dream, and it's an interesting title. It's about creating passive income. Can you talk about your book a little bit? Yeah,
so it's available on Amazon, and we were a bestseller for a day on Amazon, so we can claim a bestseller status. And I think we've sold one book in Australia, so I tell folks I'm an international bestseller author.
Congratulations!
Thanks. It was a good project. I've been thinking about doing it for probably 3 or 4 years now, but finally got the kick I needed to get it done, and so we put it out. I think about March or April of this past year, it's a little bit more about our my story of how I got started, and then goes into the importance of building multiple revenue streams, on top of your W-2, and then eventually, the goal being to not need that W-2, whether you like, some folks actually like their child, some don't, but for those that do like it, it's still important to have those multiple revenue streams coming in.
Now, is that multiple revenue streams based on investing in real estate, or do you have some other ideas there as well?
Yeah, I mean, personally, most of ours is in real estate, but we also passively invest in oil and gas as well. So we get some revenue coming in each month from that, and then we've got some other private equity investments, but those are more not about cash flows. Those are kind of what I call home run balls. Those are deals where if they hit, they're going to be they're going to sell, and it's not really a cash flow deal.
They carry more risk, but the upside is a lot greater.
Right.
In writing this book, who did you have in mind? I mean, who was the reader that you were looking for?
We've got friends and family that I've seen that one of them is a sales. Their family income is all on medical sales, and so they're it's their swings in income every quarter. It's a small salary, but then they get paid on commission, and it's seeing those folks how they have to go from eating ramen noodles to going out and having going on vacations. So it's something to smooth that over is a big deal. That those folks kind of came to mind, and then also too folks that are that are government employees, or a teacher who kind of have a lower salary, but are doing a lot of good, and a way for them to bolster their income so they can continue doing what they love to do.
So what kind of advice do you have for people like that?
I think a lot of folks put a lot of weight into their job being a very safe form of revenue, and being the CFO of an oil and gas company, I learned in that role that nothing's guaranteed, and that the most so you have to start building that passive cash flow where you've got multiple revenue streams coming in each month or each quarter, depending on when they're paid, to smooth out any of life's hiccups and all that. And it just makes it for a much smoother ride if you're able to do that.
Bringing it back to a multifamily and just residential investments, do you have any parting advice for our listeners who are looking to get into that area?
For me, it was such a great decision to start with a 76-unit deal. So I would my biggest piece of advice would be to start bigger. On when you're investing in multifamily real estate, if you're able to afford a third-party management company to run your day-to-day, it'll change your life, and it'll quickly change the trajectory of your ability to build your portfolio, which is really kind of where you make your money, is being able to buy more deals and expand your portfolio, have more units paying you rent each month and making a profit off that.
For those listeners who would like to learn more about you, get your book, maybe contact you, where would you direct them?
The best place to get a hold of us is Wolfe-investments.com, and that's WOLFE -investments.com. That'd be the best way to get a hold of us.
And your book is available on Amazon. It's called Investing in the Dream. Is it under Kenneth Wolfe?
It's under Kenny Wolfe.
Kenny, I really appreciate you taking the time to talk with us today. I mean, it's been a pleasure just talking about multifamily, and you've got loads of experience in that field as far, including, triple net, double net leases and everything else you're involved in. So thank you so much for sharing your experiences and stories with us.
Well, thanks for having me, Brian. I appreciate it.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.